Hello everyone, welcome to the Income Masters channel. It is Wednesday, July 16th, 12:30 p.m. Eastern, here with Dave Durham. My name's Emily Norris with Traders Reserve. We're going to be doing a tactical session today discussing selecting option strikes. We are recording this session and we'll post a replay to the platform. If you have any questions, just pop those in the chat box and we'll get to those once we've wrapped up with today's presentation. With that, I'll let you take it away, Dave.
All right, thank you, Emily. As I mentioned yesterday, I thought I was going to start today's session off with a trade, and since we only did two yesterday, and I had two trades ready to go, and separate slides ready to go, and just out of nowhere, the market dropped about 50 points. So that came from the president saying that he's going to fire Powell, and that was all the news, and the market just literally tanked. And now it's come back a bit with the denying that that's not what he said. They just discussed. Who knows? Anyway, so we're not going to do a trade to start. We'll make it up tomorrow and add that extra trade in tomorrow. It just was too much of a drop, both in the prices of the two underlyings I was looking at, to go ahead and go forward with that trade right now. Not that they totally would have been impacted by that, but I was looking at the screen and had no idea why the market was all of a sudden down 40 points and then 50 points. So we're gonna go on with this, which is again part of our deep dive into trade tactics. Today's session, which will be on selecting option strikes, there's gonna be a lot of familiar stuff in this, but it's also just a few nuances I want to talk about. And so this will not be a long session. It's about 15 to 20 minutes, and we'll take questions. Next Wednesday, we're going to get on to trade recovery case study. We're going to walk through two different case studies. Again, they won't be too long, but I just want to give people who are wondering when we get into some of these recoveries, are they worth it and are they not worth it to do it? We're going to look at two different ones there. And then the last session of the month is going to be a Q&A session. We're going to send out notices to you and ask you to submit questions you have ahead of time so you don't have to come up with one during the session, or if you're not going to be in the session, but I will take those and answer those during that tactics session on the 29th. So that's our schedule, rest our schedule for July. Then we'll set up a new one once we get to August. So, all right, where this is about factors in picking strikes, and it's, as you're involved in the trade setup, we've gone through a lot of this, and just whether we talked about the basics of setting up spreads or cash secured puts. So I'm going to tell you, these are the factors, and I think you're pretty much all pretty familiar with this, which is, we are doing defined risk trades. So we've got everything from days to expiration, the expected move at expiration we can look at to help set our strikes. Delta, we use delta a lot, although it's not the only thing. Bid-ask spreads, just because we get a good delta and we get a good expiration time period, doesn't mean there'll be liquidity there. So we need to make sure is there. Then I look at return on capital. What's the potential return if we can set the trade up and take it and go out, and then even acceptable credit. Sometimes the credits keep dropping on us as the stocks move up and down. So days expiration. This is again probably going to be repetitious, but it's just a reminder that there's different time periods that can literally. You can range from 0-1 DTE trades to 2 to 15, 60 to 28, 30 to 50 days, 35 to 50. It's obvious in the 2 to 15 time frame you have less time exposure, but less time to manage if the stock trade goes against you. You do get a quicker theta decay. And so when they do those trades, it tends to be trades that I'm either pretty bullish about or pretty bearish about. In other words, I'm expecting the move to happen in that short period of time, so that whether to the bullish side or to the bearish side, so we can set up the days to expiration on a shorter time frame. This tends to be what we look for when we are doing the income madness trading sessions. 16, 20 to 28 is kind of that middle ground. It's a more medium term, gives you a little more time to manage the position if it goes against you at the beginning. These we also do during income madness, but we do run some of these time frames in masters as well. Some of it is driven by, you're very familiar with this, option liquidity. If we get into a stock that has weekly options, but the off weeks, other than the monthly, are very light in trading volume, particularly open interest and volume, then we have a challenge there that we can't really go into that expiration, even if it fits our criteria for our time frame. So sometimes we have to take a little less, fewer days to go at the monthly rather than going out to the, say, let's say the 35 to 45 day time frame. 35 to 50 days, really kind of the best opportunity to manage those trades early. They're neutral to slightly bullish or bearish. So it's a very much a neutral strategy at that time frame. Again, we talked about the fact that we don't need stocks to move dramatically. They can just move a small percentage, not even a percentage, 1%, a 0.5% or less, and we can still make money with those. That's proven over time to generate more consistent results, depending on the underlying. And again, that's depending on the underlying, because again, sometimes we're restricted about going out to 45 days because we can't find expirations. And you have things like earnings in the middle of that as well. So all this plays in a factor there. Delta selection, okay, we start out with, can we get a 15 to 15 delta, and then how close can we get to 20 delta? With so the higher probability of out of the money is going to be at the 15 or less, and the probability of finishing out of the money decreases as we go further up the deltas there, 21 to 30. You collect more credit, but there's less probability of finishing out of the money. So we obviously focus on that, but that's not a final factor. I mean, it's not well, we've got to stick with 15 or we've got to stick with 16. A lot of times we focus on 15 to 22 delta in our defined risk trades, and we can actually sometimes get better on the cash secured puts, depending on the credit we're getting, depending on the credit we receive. And it depends also on the underlying we're trading. So sometimes we can get away with a 12, 14, 15 delta on the cash secured put or a buy right, where we're taking more of 15 to 22 delta in our defined risk trades. But that's not universal, because there's some stocks that just don't match up to those. Expected move. This is something we've talked about. I look at this at the beginning every time we set up a trade or go to get a trade setup ready for us to go over during the session. But I'm using this a little less because sometimes it's a number that changes automatically. And so if you're not sure first of all, if you're not sure what the expected move is, one standard deviation is 68%, meaning up or down. That stock can move 68% to the upside from where it is now, or it can move down 68 or 68% of the time it can move down to the down price, and the other time 68% up in price. 68%. If you want more certainty, it's a 2 standard deviation, but that means you're going to take it down to almost a 5 delta to get a 95% certainty that you're going to finish out of the money. And if it's a call, it's 95% certainty on the call side. And of course, the 3 standard deviation is almost perfection, but that's rarely, and I say that pretty categorically, you're not going to find credits at 99%, let alone rarely at 2 standard deviations. So typically you look at the 1 standard deviation, but it's not always, it's a starting point, but it's really kind of in the back of my mind when I'm looking at this and when we're setting up trades. The other thing is acceptable credit. Sometimes we get our math correct. We get a good delta. We get days. We think good days to expiration. We've set up everything ahead of time, and then we go in there and find out the credit is not there, or it's because of the trading volume, the credit can vary. So we've talked about this before in sessions, even before we started doing these daily channel sessions. We'd love to get on a one wide strike, 25 to 40 cents, or 20 cents is kind of the minimum. And 5 wide, we'd like to actually get, 90 cents to $1.10 to $1.20. In fact, the rule of thumb on an option selling is if you can get 1/3 the width of the spread, that's a good trade. Well, you can get 1/3 of the width, but you're going to probably be at a 28 to 30 delta, particularly in times of lower volatility. And we are, pretty much a VIX under 20 is considered relatively a low volatility environment. And certainly right now we're at 17. At least we're 17 earlier here today, 17 to 14. And we existed a lot in 23 and 24 in that 13, 14, 15 range. It's just harder to find that you're going to get the width unless you really go much closer to at the money. So again, we're striving to get 90 cents to $1.10. It's not 1/3 of the width on a 5 wide strike. You've seen us, we've taken 70 cents, 60 cents, and it also depends on the days to expiration. So a lot of time this is a moving target because we're trying to adjust a number of these numbers and then fit what fits best for us on this trade. And it also depends on our outlook on the underlying. Are we bullish? Are we just neutral to bullish? Or even we like to phrase it as neutral to slightly bullish or neutral to slightly bearish. Return on capital, return on capital, our targets, we try to get a 20, 25% gross, meaning when we set the trade, if we can collect it, 20 cents on a dollar, that's a 20% gross, or 25 cents, that's 25%. But then we know if we set a target exit price and exit early, we're going to give some of that back. So on the net, we're looking for 10 to 12.5%. And it's obviously it's just the credit divided by the width of the spread less the credit received. So we count that in there because you're not putting that capital out. You collect that credit, you're keeping that credit is yours, and it counts against the basically option buying power. So through the first 6 months, and I went over these in our review last week, we've averaged 9.8% on our net return on capital. And we've had trades that finished anywhere from as low as 1.4% to as high as 33.7%. And we still have, obviously, from several positions open from the first 6 months that probably not going to reach anywhere near that. So those are the wide ranges, but generally we've been hitting about the 9.8, and even just the first couple of trades we closed here in the second half of the year, I think we're at the 9.8% range as well. One that's kind of that I look at too, and I haven't really talked about as much, is return on capital per day. And this starts to play into factors when you're adjusting trades and extending duration beyond because of having to defend a trade. So if the return on capital's ROC is the credit divided by the width of the spread less the credit received, then you start estimating that. But the final credit is how many days you actually spend in the trade. Oh, sorry. And then to start getting a return on capital per day, it's return on capital divided by the DTE, 30 days. So if you have 30 days to go, and you can actually on Thinkorswim pull up a column on your option chain that says ROC. I keep this column open most of the time because I tend to look at it and see what I could get there. So the idea being, if you take this here and divide it by the 30, that 30 days open, that will give you the actual return on the gross basis, basically before you start the trade. But the way I calculate the return per day is it's return a day, the days in the trade after we've closed the trade. So it's return on capital, how many days we're in the trade, 5, 10, 20, 30. The ideal target for us is 1 to 2%, but we'll take 0.5% to 9% per day. Again, I mentioned this last week at Income Masters, we averaged 1.8% for all closed trades, not for those trades we rolled. And we had a high return of 11.1, which is probably if I think back on it, it was a madness trade that closed in less than 1 day and had a high return to begin with. So we're probably getting that full amount of money on that first day. On it, we got as low as 1/10 of 1%. And roughly, if you think back to the Costco trade, I think that was about 0.2%, or it was 2.2. So it was so that's what we're going to talk about further as we could go through the coming weeks and stuff is, okay, how long do we keep these trades open? Is it worth getting that 2% or 0.2? No, it's not, but it is a factor of a rolling and then coming back and still ending up with an additional profit. So here's maybe a better way of illustrating. This is I pull up this, I think this is Meta for August 15th expiration. That's the DTE is 30 days. Here's the ROC, and if I just do some quick calculation, let me just come down here at let's just call it the 16 delta, 10.9%, 10.9 divided by 30, and equals, that's basically 3.5%. Let me, I think I can do this. We were testing this out before. So that was 10.9. That's a percent. Sorry about that. Divided by 30 days equals 0.36%. So that's below that level of 0.5%, but that's the gross. We're not going to probably be in a meta trade for 30 days. We've been exiting trades, as you know, in anywhere from 8 to 12 days. So that's the gross way. But I use this sometimes to look at where I find if it matches up pretty well that I can get a 0.5% at the 15, 16 delta, 0.5%. That means I'm getting a pretty good chunk of credit that's worth trading at that point. This is the short strike, not the long if we're doing spreads. It's just the short strike I'm looking at. But that's one way I use this is actually sort of just do another checkpoint on, am I getting enough acceptable credit? And on a stock like Meta, I'm not worried about the bid-ask spreads. They're very tight, and generally stocks that are widely traded with volume, I don't have to worry about them with open interest and volume. But again, that's another thing I use just as a checkpoint to see, okay, am I getting enough? Can we lower this a little bit? So I do this basically before I do a setup and put it on slide screens, and then we go out and look at it. And sometimes we have to change it depending on what's happening in the market real time when we're making the trade. All right, so I can clear all that. So here's a checklist, again, sort of the numbers that I kind of mentally go through each time I'm setting up a trade, getting ready to put it together and looking, can we trade this today in our session or tomorrow, whenever we go through this. The ideal target is 35 to 45 days, but we'll take 7 to 21 and even 21 to 31, depending on conditions and type of trades. And really, to me, it's more, am I really bullish or bearish on the underlying? Deltas, we'd love to hit every delta and get a ton of money at 15 or less, but that doesn't always happen. We're generally in the 18, 19, 20 range. We've been averaging about 19 in the first 6 months, but we have gone up to 20, 21 to 25, particularly again if we're somewhat bullish. Expected move, we just want to set the short strike outside the expected move, but that's not always possible. And so I've come to use that as just a initial checkpoint, but that's probably less reliable because again, it's a probability that's basically 68% of the time it's going to happen, but it also means 68% of the time the stock can move to the other side of the trade. So if you're doing a puts trade, it could be up 60, has a probability of moving higher 68% of the time. Bid-ask spreads, we like to keep them 5 to 10%, but we sometimes have gone as wide as 50 cents, depending on liquidity and what we're trying to get into at a different time here. Credit, again, we'd love to get 30 cents or more on a one wide, but generally 15 to 20 cents or more on a one wide. And we talked about 80 cents to $1 on a 5 wide. So It really is, and then again, the VIX, the volatility in the option environment really plays into this as well. Return on capital, again, we're looking at gross of 20 to 30% and net of 10 to 15%. We'll accept, anywhere from 8 to 10%. And these are all undefined risk trades, i.e. spread trades. And then return on capital, if we can get 1 to 2%, we'll take that. But we also can live with 0.5% to 9% on return on capital per day. So there it is. It's pretty straightforward, but there's a lot of numbers that come together. We always talk about the fact that we're using a lot of math and probabilities to set up trades, to get the right strikes, to get the right amount of capital we want to take and get the exit prices. So these factors, again, days to expiration, the expected move, delta, the bid-ask spread or liquidity, return on capital and return on capital per day, as well as an acceptable credit are really the factors we look at there. So again, I know a lot of this is really not new. It's mostly the factors we talk about in our trading sessions, but I wanted to kind of pull some of that together to get you thinking as well about how when you may think about setting up your own trade, looking at this as well. So that's it. I'll take questions, Emily, and then we'll get back to trading tomorrow.
No questions, just a comment about the Greek probabilities and options premium. I guess just that they're all backwards looking, no knowledge or ability to see into the future.
Right. Yes. Yeah. And in fact, all these numbers are probability numbers. The expected move is looking into the future, for example, but it's also probability. It's not nobody can look exactly into the future. So expected move is a forward-looking calculation, as just as implied volatility for that expiration as well. So you do have ways of sort of looking at it from a mathematical way into the future, but it doesn't guarantee you're going to get that as well. That's why I sometimes check in with return on capital per day to see, well, maybe I can make this at this level and still get an acceptable credit at at a lower delta to ensure the trade finishes out of the money.
Okay, Dave, that's it for questions or comments.
All right, we'll be back tomorrow. Sorry again about that trade today. I know the market has bounced mostly back to where it was. It was at around 62.55 when that news broke, and then it's now back almost to 62.48. So we will make up trades tomorrow, at least have 3 trades tomorrow, and we can always trade on Friday. So join us then, and we will have a couple of different type of trades tomorrow as well. So it will not be just a straight put spread trade. So look forward to getting back together and trading tomorrow. And with that, have a good rest of the day.
All right, thanks, Dave. Thanks, everyone, for joining us. We have recorded this session and we'll post a replay to the platform. We'll see you tomorrow for live session at 12:30 p.m. Eastern. That is where we discuss trade adjustments, including the meta trade that people are asking about. And we will, just between now and then, though, do keep an eye on your inbox for alerts managing open positions in case we manage anything ahead of that session. Thanks and have a good day trading.